Hello everyone, and welcome to today's screencast of Principles of Accounting, the Matching Principle, and Revenue Recognition. What are the accounting principles, and specifically, why is matching revenue important? The accounting principles are governing fundamental guidelines and rules that are set by the AASB to regulate and control the actions and procedures of accountants and businesses alike. The matching principle and revenue recognition principle are integral to accurate financial reporting as they allow for the comparability and verifiability of financial records. The matching principle is also what differentiates the accrual basis of accounting from the cash basis of accounting, where the cash basis records revenues when cash is received and records expenses when paid, and the accrual basis records revenues when earned and expenses when incurred. This must be used under the GAAP. According to the GAAP, the matching principle can be defined as matching revenue and expense earned or incurred by recording in the period that this has occurred. The matching principle also ensures consistency in a business's financial records as well as that of other institutions. According to the AASB website, when corporations and other organizations comply with accounting standards, their general purpose financial statements will be more comparable than otherwise would be. This allows investors or other users of the financial information to better compare organizations. The matching principle allows for this comparability for both investors and supplementary institutions, which fulfills assumptions and objectives set by the AASB such as consistency, relevance, faithful representation, and the ease of interpreting this financial information. Why can't we use the direct write-off method to account for bad debts in Australia? As the direct write-off method can understate profit, it may allow managers to manipulate their financial information to create a bigger margin and allocating a business or individual to a lower tax bracket. Here's an example to try and help understand this. Jordan is an accountant. To summarize the bad debts he rules to be uncollectible, Jordan decides to use the direct write-off method to write the concerning accounts from the books. Jordan generates $340,000 in profit in the last period and has estimated $89,000 to be uncollectible receivable accounts. As this is a materialized loss, this would greatly impact his business's profit figure. This would lead to lower taxes as his figures are understated. Consequences for violating the matching principle and the generally accepted accounting principles. As Jordan has done this, he could potentially face tax consequences for writing off a materialized account, and therefore his profit percentage at the end of the year would appear to be lower than it truly is. In theory, he would be paying less tax. Companies can face fines for understating profits or losses if audited by the ATO, and this can extend to time in prison. For example, in 2019, a bricklayer was sentenced in a Queensland court to 2.5 years jail for understating profits. He stated $85,000 over 4 different periods. However, the bank revealed deposits of upwards of $350,000. Thank you everyone for watching, and I hope that this made this concept a little bit easier for you.